Welcome to Policy Chats, the official podcast of the UC Riverside School of Public Policy. I'm your host, Dory Pham. Join me and my fellow public policy classmates as we explore potential policy solutions for today's most pressing societal challenges.
Welcome to Policy Chats. I am your host for this special series on technology and government, Lloyd Levine. The series is based on my recent book, Technology versus Government, The Irresistible Force Meets the Immovable Object. Today, we are talking about Chapter 8 in the book. The author, Graham Steele, I'll let him tell you about his background. It's extensive and varied. Is going to be discussing cryptocurrency and the chapter Cryptocurrency, the Miner of Last Resort, and that's MINER, and the implications of cryptocurrency and blockchain on the central banking functions of government. So without further ado, Graham, why don't you just introduce yourself, give a little bit on your background. You've kind of gone back and forth from government to academia to government, and now you're back at Stanford again. Tell people a little bit about yourself, and then let's kick this off with summarizing the chapter. As I've said, in every episode so far, the purpose of this podcast is not to just do a verbal version of the book, not to summarize the book and to say the same things, but I do like to start with a summary of the chapter. So go ahead, tell us a little bit about yourself and then summarize what you wrote for us.
Great. Well, Lloyd, thanks for having me, and Rachel, and to the UC Riverside Policy Chats podcast. Looking forward to the conversation. And thanks for allowing me to contribute the chapter to this volume. My background is, as you said, I've sort of hopped back and forth in the policy and academic worlds. My formative experience was in the federal government, working in the United States Senate for almost 8 years, for a member of the Senate Committee on Banking, Housing, and Urban Affairs. And really the first professional experience I had there was with the financial crisis of 2007 to 2009, and then working on something called the Dodd-Frank Wall Street Reform and Consumer Protection Act in 2010. I worked in the Senate, as I said, for almost 8 years, eventually as the head lawyer for the Democratic staff of the Senate Banking Committee. Then I moved out west to California, to the San Francisco Bay Area. I spent a brief period of time at the Federal Reserve Bank of San Francisco out here. And then a friend of mine recruited me away to run a research initiative at Stanford Graduate School of Business called the Corporations and Society Initiative. And then more recently, I spent the last 2+ years at the United States Treasury Department as the Assistant Secretary for Financial Institutions at Treasury, which is responsible for banks, credit unions, insurance, community development and investment, consumer financial protection, and financial sector cybersecurity. And I left that post in January of this year. And since August, I've been at Stanford Law School as an academic fellow at the place called the Rock Center for Corporate Governance. Now, you asked me about the chapter and how to summarize a complicated issue like cryptocurrency in the short time we have here. I think at a high level, what I do in the chapter is explore the challenges and opportunities that are presented by the crypto movement that's garnered a lot of momentum starting around 2008. And basically, this movement seeks to create as I argue in the chapter, a privately administered system of currency, money, payments, and increasingly these kinds of investment products. And we'll probably unpack this a little bit more, but the term cryptocurrency is quite a broad one that applies to a lot of different kinds of digital assets that have specific features and use cases, as well as the underlying technology that applies to those digital assets. But really the point of the chapter, and why I think it fits in with the broader theme of the volume, is that cryptocurrency really highlights an important long-standing tension in banking, finance, and money, which is how you balance innovation, including technological innovation in that space, with the goal of safeguarding the stability of the broader financial system, so you don't have crises like we had in 1929, the Great Depression, or in 2008, the global financial crisis. And the way that I tried to hone in on that tension and tease it out was looking a little bit more at the history of private money creation in some of those prior episodes, and then the fragmented oversight of these different kinds of private money and sort of how they led to to instability and panics. And the two examples that stood out to me were first the pre-Civil War so-called free banking era, which was when private banks were issuing their own banknotes and the states, not the federal government, was overseeing the banking system. And then the second was the pre-2008 crisis financial markets, when financial institutions tried to replicate banks' activities through lightly regulated financial instruments like securitization, short-term IOUs like commercial paper and repurchase agreements or repos. And that whole model is often referred to as shadow banking, which is these non-bank financial institutions that are issuing these products and claims that are similar to banks, but not subject to the same kind of regulation. And then, what I look at then is the runs and panics in the financial system that date back all the way to the Civil War in the case of the free banking era, or the Great Depression, or the types of risks in these shadow markets from 2007 to 2008, and try to then analogize that to the way that crypto is manifesting and sort of what that might look like. And, in just the time since I started writing the chapter, we saw some of those similar type of runs happen in cryptocurrencies in June 2021, again in the summer or fall of 2022. And basically my main message of the chapter is that we have these two salient examples, the free banking era and the shadow banking era, of what happens when we allow unregulated private money creation to grow out of control. In each of the previous cases, that results in financial instability that ultimately led the government to support these private money markets and then also create or strengthen federal oversight of the markets. And so the last section of the chapter really explores some of the options federal financial agencies, largely the Federal Reserve, which is the central bank that administers the money supply and regulates the banking system, the steps that they could take to have greater oversight of cryptocurrency markets. Because my argument fundamentally is that cryptocurrencies raise a lot of the same issues as traditional money and banking products, and a lot of the authorities and tools the Fed has are already fit for purpose.
So essentially what I think I understand, and please do correct me if I'm wrong, this is not a place where you need to be a sycophant to the host. You're saying historically when this has happened, instead of shutting them down, because that might not be possible, the federal government's then regulated and brought into the fold. So you start off as a shadow banking entity, something happens and the feds say, okay, that can't happen again and we're not going to co-opt you. Now, what's different this time is the internet, where the barriers to entry on digital currency, et cetera, are a lot different than some of the other other currencies in the past, where not everybody as the old adage goes, sitting in their parents' garage, et cetera, et cetera. Do you see a difference with cryptocurrency and the lower barrier to entry than in the past?
I see similarities and I see differences. The similarity that I see, and the reason I'm arguing by analogy between cryptocurrencies and some of those prior product services, is that the features to me sort of echo from those past eras to the current era, and so to me the products and services being offered to the consumer here are very similar, whether it's supposed to be a money type product, whether it's supposed to be a payment service, or whether it's an investment product that someone's supposed to put their money into that will then appreciate over time. So to me, the part of it that's the cryptocurrency part of it, to me, has echoes with some of these past products and services. The piece to me that is different, and this is getting back to my an early point that I made about the fact that the Trump cryptocurrency sort of conflates the products and services with the underlying technology. The technology itself, to me, is the part that is novel. It is novel in the sense that you have a different model for how transactions are recorded when I'm moving money, from my digital wallet to yours. The place where those transactions are being recorded, they're being now recorded on these digital ledgers that are overseen by a third party potentially. They happen much faster. They settle in shorter amounts of time. So the technology itself has different kinds of features to them. But that to me, so while the technology is distinct from some of the technologies that have sort of sat beneath the financial system in the past, the technology behind finance itself has evolved over time. So that is not the evolution of technology in banking and money and finance isn't a new problem. You can think of the fact that banking started out as branches on the prairie where people would come in with their banknotes and redeem them, and there was a gold-backed system. Now we have apps on our phones where I can send money back and forth amongst each other. So while the technology is different and novel, this idea of innovation and technological evolution isn't a new problem within the banking system.
But how do you factor in the democratization, I guess I would say, of cryptocurrency? I mean, historically, as I'm understanding from you, and as we established at the beginning, this area is absolutely 1,000% yours and not mine. I'm hoping to keep up here, but as I understand historically, it was still coming from mostly institutions or well-established entities coming up with additional products. And there were relatively few of them. Here, with the democratization of it, and even you talked about apps on your phone, like, Venmo and PayPal and things like that. Even with those, for the most part, you're still paying people through your phone utilizing technology, but you're paying them in US dollars if you're in America, or you're paying them with euros if you're Venmoing into other countries, et cetera. Cryptocurrency has, to a degree, created a wider base of people who can both create a currency, and maybe that currency has created spikes and crashes, and it from what I've seen and what I think I understand, it hasn't completely broken the connection to the dollar either. I mean, they're valued at certain things on commodities exchanges. And so in addition to the technology that you've identified, I think the technology has allowed a democratization. And how does that play into your thinking?
Yeah. Sure. Again, I think it is a new version of an old problem. We have long had as a policy goal bringing as many people as possible into the banking system. This is what's called the underbanked problem. Rely on alternative financial products and services, payday loans, check cashing services, things like that. There was a history in our country of so-called redlining, of keeping certain populations on the basis of race out of the banking system. So we've long tried to, in that way, democratize the banking system by giving everyone access to it. But there has always been a balance there as well. You're trying to keep criminal groups and illicit actors outside of it too. So even in the legacy banking system, there's been a tension of trying to give as many people access as possible to things like banking and money, while not allowing bad actors, fraud, illicit finance, things like that in. And so to me, again, it's a sort of a new version of an old problem. But to me, one of the risks that gets created is the one that you're highlighting, which is to the extent that some of these crypto products and services are trying to replicate or replace the dollar and the monetary function that the government plays, that creates a problem. It creates a problem for national sovereignty, for democratically elected governments determining, the stability of that dollar system. So there's sort of a democratic issue there. And it also leads to these financial instability issues. When private financial institutions issue a lot of these claims, it drives up the price of a certain asset class, like a cryptocurrency, that potentially creates a bubble. Eventually that bubble can pop and it can spread this risk and financial contagion throughout the system. And so that is a balance that these public sector entities have to take into account, is how they actually maintain control over that and maintain stability, because those historical examples show that when you want to allow for competition and innovation and for democratization, without allowing some of those risks to run wild. And then the third thing I would say about that is the point that you made, which is right now crypto is offering itself as an alternative to those systems, but very much is still an appendage of the regulated banking system and relies on the US dollar and traditional currency to actually operate. A lot of the crypto companies, when they have excess funds, they deposit it in a bank. When someone wants to pull their crypto out and cash it out, they're transferring it into the banking system and then pulling it out of their bank account. And so right now, in terms of the viable use cases, they all very much do rely on this traditional regulated system and are not necessarily operating as an alternative to it.
Okay, I'm glad that I understood that decently well. Before we move on, people often conflate blockchain and cryptocurrency. You made reference to the ledger earlier. Can you just give a quick, description of what is the difference between blockchain and cryptocurrency, and how do they work together?
Sure. I will do my best here for your listeners that are steeped in this stuff. I'm going to try to give a high-level explanation. It's going to, obscure some of the nuance here. So
the ones who are steeped in this already know the difference. Interest in policy, maybe an interest in technology and policy, but aren't steeped in the nuances of it.
Absolutely. I don't want to get angry emails about how I miss this one minor detail here. I'm trying to boil this down a little bit here. But
what keeps me awake at night? Not getting angry emails about stuff that is like nitpicky. Yes,
I get plenty of them already. So there's a distinction, as I alluded to earlier, between the crypto assets themselves that are being transferred to serve a financial function, like making a payment or an investment, and that's the cryptocurrency part. These are digital assets, basically ones that are digital representations of other assets, or ones that are exclusively digitally created that can either be traded or held on to just like any other kind of financial asset. So the examples of these kinds of things are like Bitcoin, which people have probably heard of, so-called stable coins, the largest of which is called Tether, which is it's called a stable coin because it's supposed to maintain a one-to-one relationship with the US dollar, or things like non-fungible tokens or NFTs that people have probably heard of as well. Basically, these are assets that are supposed to be transferable or tradable. They're sort of the customer or investor facing part of all of this. And then, so that's the cryptocurrency part. Then you have the underlying technology, the most commonly discussed of which are blockchains, which a blockchain is a type of what's called distributed ledger technology, or DLT. And here again, this is the part where I'm going to oversimplify a bit, but basically those technologies are a way for data to be shared across a network through the use of the digital ledger to record and verify transactions. So to oversimplify all of this, let's say I want to transfer one Bitcoin to you. I'd have a digital wallet that stores what's called a key that gives me the ability to access my Bitcoin, which is recorded on that digital ledger. And so I'd use the key to send you the Bitcoin. Then others who are part of the network would use cryptography to verify that transaction with my key and your key, and then to record the transfer of ownership of that Bitcoin and then the underlying monetary value of that in the underlying digital ledger. So that's sort of the fundamentals. You've got the crypto asset, you've got the underlying blockchain or digital distributed ledger technology underneath that sort of records those things. And then there's a whole other ecosystem of other entities that play some sort of role here, because there are things like platforms like Coinbase or Binance or the entity formerly known as FTX that folks might be aware of, where they will list these crypto assets. They will hold on to the keys for us. They will conduct some of those transfers. There's a whole other ecosystem here that sits in between all those different functions.
That was pretty understandable. It was simplified, but I think it was excellent. So, to the layperson, and I will say I'm probably slightly above a layperson, but nowhere near the expert you are. A lot of what people talk about when they talk about cryptocurrency sounds just like, what's going on in the U.S. mainstream U.S. monetary policy system. We have for years now been trending away from paper money. It's still the U.S. dollar, but most people don't write checks anymore. Rachel, do you have a checkbook?
I do not.
Okay. that used to be the right of one of the rites of passage is like I've got my own checkbook now. When I was a Riverside student, I paid the rent by writing an actual paper check, and you'd sign it every month and all of that. I don't do that anymore. Once in a blue moon, maybe. How is cryptocurrency different from just the digitization of the US dollar, which is becoming increasingly, as we said, paperless? We've got ATM cards, we've got Venmo, we've got, I have a watch that has my credit card information. If I need a Gatorade, I can find a store and I can pay for things with my watch. How is cryptocurrency and its promises, et cetera, different from what's already being achieved with just the natural innovations of digitization of dollar-based products?
Sure, it's a great question. I think the place that I would start with the distinction here is at sort of a structural level with the distinction between private money and public money like the US dollar. There's been a lot of conversation recently in financial policy circles about the definition of what money is and the attributes that it has. And basically, traditionally, something's thought of as money if it can be a store of value, a medium of exchange, or a means of payment. It has to have all three of those features in order to be really viewed as something that is quote unquote money. And so you think about something like a bank deposit, which is widely agreed upon as one form of money. And a deposit is a claim on the bank that issues it to provide the depositor with the right to receive US dollars at any time on request at the par value of whatever that deposit is valued at. And so that value, the value of that claim, that bank deposit, is publicly insured up to a certain amount by the US government. And it is entitled to preference if that bank actually is insolvent. You get a one-to-one payout on it, assuming you're below that threshold. In addition, that issuing institution, that bank, has access to emergency liquidity if it needs it from the central bank, which is the Federal Reserve here in the US. And it's subject to ongoing supervision and regulation by that central bank, designed to limit the riskiness of that issue, of the bank's balance sheet and its operations. So basically, it's got a whole bunch of protections from the federal government to make sure that if I want to go in and redeem my bank deposits, I'll get my money back out of it. So those attributes are really essential to determine that this thing is actually money and that it will be made good. Yeah. The distinction there, is that between public and private money is private money usually serves some of those functions, but not all of them. Now, before I sort of turn to the distinction in crypto and sort of what's going on there, you noted that there are all these new digital apps and products and services sort of coming up in this ecosystem. PayPal, Venmo is an example of this, where they offer a digital wallet that I can put my funds into, and I can transfer them more quickly. We can do it more quickly from one to the other. But if I'm holding a balance at PayPal or Venmo, that isn't insured. And so there's this sort of intermediate step here of these new money transmitters that sort of sit in between the traditional bank and the crypto ecosystem, but they're still, sometimes they do offer crypto to their customers, but for the most part, they're dealing in money, but they're not quite the same as a banking institution might be.
So they're kind of, the way I understand Venmo works is they don't actually hold money. But maybe I'm wrong on that. I know that every so often when I use my, Venmo app, I have to reauthorize my bank, and it's just assumed that the money sits in the bank, not at Venmo. In fact, I do have a small balance on Venmo, and I could move more to it, but it seems to me like I've got the balance here, and then I send it to wherever it's going, and it's not really held in Venmo.
Well, there's an intermediate step where if you have a wallet on one of those payment apps and it sits in the wallet,
got it.
Venmo is holding on to it, and there are ways that they could deal with that. They could create an individual bank account for everyone, or they could aggregate all of their funds and put it at a bank. The distinction there being if you have an individual account, that's insured up to $250,000. Everyone's funds are pooled together. That entire amount itself is also only insured up to $250,000. So understanding those distinctions of how that kind of payment app actually stores your own funds is a really critical distinction in determining what happens. If they, God forbid, went into bankruptcy, whether you would get your money back and how much of it you get back. Now, Well, I was going to get into sort of the crypto and sort of where it sits here too, which is the proposition that crypto is offering is a lot of those similar sorts of peer-to-peer payment services. But the value proposition here is supposed to be that you and I are just transacting with one another. We're cutting out the bank, which is the middleman in all of this, which is supposed to make it faster for me to send money to you because you're not waiting 2 to 3 days for a transaction to settle. And just because there's more innovation here, the technology speeds this stuff up, the cost is supposed to be lower. And so that's really the value proposition. It's supposed to use technology to lower the cost and reduce the timeline for us to be able to send money to one another. Now, I mentioned those 3 characteristics of sort of what money really is. Is it a medium of exchange, a store of value, or means of payment? Depending upon what kind of cryptocurrency you're using, it may not actually share all of those attributes. And at least right now, the federal government doesn't stand behind it. It doesn't guarantee it. And so there's a risk there that you might not actually get your funds back if you're sending it. We both have wallets at Coinbase that we're sending to one another. It is not protected in the same way that it would be if we just had our money at a bank and we were sending it to one another. The experience that customers of FTX had was FTX went into a bankruptcy process where all the customer funds got pooled, and then they had a claim against whatever assets were left. And, I think most of them, as I understand it, were made whole ultimately. They did get their money back. They just waited months and months and months and months, if not years, before they actually got the funds back. So it is not the same sort of quick, they were made whole, but they didn't have access to, if I had $10,000 there and needed it and couldn't access it for like 2 years, it's not the same as just getting paid out. If you were in a bank, you'd get that $10,000 back if you wanted it the day after they went into a receivership.
Okay. So I think that mainly answers, but I had a note here, coming from the public policy side, not the banking side. Usually when you're promulgating some sort of public policy, you're trying to solve a problem. Technology will often try to solve a problem. What is the problem? And maybe you just articulated it. What's wrong with the current system that, if anything, that will be improved with cryptocurrency?
Well, I'll talk a little bit about sort of what the use cases are and the problem they're purporting to solve. And then maybe I'll walk through a little bit of sort of some of the other problems that are involved or what gets created there. One of the problems that they are purporting to solve is the one that I just mentioned, which is banks are slow, clunky, and expensive institutions to deal with. And so the promise here, the value proposition is we will make it easier for you and I to transact faster at lower cost, which will benefit us, as an alternative to the banking system, but also potentially that could bring other new folks into the banking system for whom it was too expensive to actually use a traditional bank, or for some reason or another, they were sort of distrustful of these incumbent banking institutions based upon some sort of economic experience they have had with them. There's also, from the original Bitcoin white paper that was written back in 2008, there was also a little bit of a political economy argument that Bitcoin proponents were making, which was people were angry at Wall Street banks after the 2008 financial crisis. And so part of the proposition here was also, let's get big banks out of the way. They took a lot of risks. They got bailed out by taxpayers. We don't want to do business with them anymore. Here's a more democratic way for us to engage with some of these financial products and services. So that's a value proposition. One of the things we used to talk a lot about when I was at the Treasury Department was the term responsible innovation. That was really the thing that we tried to key off of, which was, are there new innovative products and services being offered here, but also are they being offered in a responsible way? And so each one of those each one of those value propositions that are part of crypto potentially come with their own different sets of risks, some of which we've already sort of touched on, which is giving private sector entities control over the money supply comes with its own set of issues around sovereignty and financial stability and things like that.
Going back to something you said earlier, I think I understood it. Like, you need to have agreement on what money is, and we all, agree that the U.S. dollar, the official currency is money. With cryptocurrency, we have, as you identified, several of them. What kind of agreement is there as to what is legitimate and what's not legitimate, or is that kind of the wild, wild west?
Well, that's one of the reasons that cryptocurrency hasn't displayed all three of those monetary attributes that I talked about earlier, is that right now there isn't an agreement around what a lot of these different coins, these cryptocurrencies that are being created are actually worth. And so really what they are being used as is basically that store of value function, as an asset that people can put their money in that will hopefully appreciate. So most of the use cases now that you see people using them for are more as an investment product than as a sort of stable payment instrument that will maintain its value over time. And so that's one of the interesting contradictions underlying the whole project. Is it's supposed to crypto is supposed to democratize and decentralize a lot of these financial products and services, but one of the things that makes money stable and trustworthy is what you're saying is the sort of societal consensus that $1 really is worth $1. So there's an interesting underlying tension in this idea of fragmentation and decentralization and the need for a consensus around what money is, what is actually worth, and then we also trust that the system works well.
So we went from the barter system to central banking to the digital barter system is almost what it sounds like. We can have multiple coins and we can just all decide what it's worth. And okay.
It's uncovering a little bit of like the philosophical underpinnings of money, which is that, there had been a gold standard where there was an amount of dollars that were transferable into gold. We got off of that system. Now money really is fundamentally about societal trust and trusting the government will make good on the dollar. And then we all trust one another and can keep continuing to function. So it at least is provocative in the sense that it really makes us ask sort of what is underpinning this entire monetary system.
Right. Yeah. So as I'm looking at kind of a variety of different possibilities, here, one thing that connection, of course, you need to have some sort of device. It could be a laptop, it could be a phone. You have some sort of device, and you need to have some level of digital literacy skills. And in this case, particularly, you also need to, it seems to me, have some level. I don't think you need to have financial literacy skills very deep to utilize Venmo. But I feel like with Bitcoin and cryptocurrency in general, not just Bitcoin, you need to have some sort of financial literacy, and so, and that plays out in a variety of government services where that digitally obtaining government services is challenging. Does without a different regulatory framework, a better regulatory framework, and a technology component sponsored by some entity, the government presumably, does cryptocurrency run the risk of creating a digital banking system for the well-off, and leaving lower income, digitally disconnected individuals outside of that digital system?
Yeah, I mean, this is an excellent question because that idea of what's called financial inclusion, basically that idea that I referenced earlier about bringing populations that use those alternative financial services into the banking system, is really a central part of the crypto debate. Is to what extent is there a proposition here about crypto being able to further financial inclusion? And it's one, when I was at the Treasury Department, we looked at that issue as one of the reports that we had to do pursuant to an executive order that the president had issued. The question was, what is the prospect here for consumers? And in particular, what does it mean for certain populations that have been left behind by the traditional financial system? And one of the things we found when we were looking at, not what the prospect could be, but sort of what is happening right now on the ground with respect to this issue of financial inclusion, really what we found was that most of the available evidence suggested that those benefits are not yet materializing for one reason or another. One was that just this extreme price volatility meant that it was being used essentially as a speculative asset for people who already had money. They could throw a few $1,000s, take a flyer on some of these coins, and maybe they would hit the jackpot, maybe not, but no big deal. But it wasn't a central part of their investment portfolio. It was just sort of a thing that they could do on the side a lot. I mentioned earlier also that need for access to an account with a traditional bank in order to get in and out of the system with these on and off ramps. And also that the transaction fees here are actually a little bit are higher in the crypto ecosystem. The fees you would pay to take that money in and out and transfer counterintuitively were higher than some, things the fees you would pay to a Venmo, a PayPal, even a traditional bank in certain cases. And so, those were some of the challenges in actually making crypto an alternative and a tool for financial inclusion. Now, you mentioned the digital divide that we have in this country. You probably already know, because you're steeped in all of these issues, that we went from less than 1% of the world's population using the internet in the 90s to over 60% of the world being internet users in recent years, which, that is remarkable progress, but 40% or 40 or 30 some odd percent, whatever number actually is today, is still a significant number of individuals, including those in the US, who lack access to reliable internet. And so, if you don't have digital access, you're not going to be able to use digital assets, other digital products and services as well. And one of the things we know from a lot of the household surveys that have been done is that those same individuals who lack access to the internet are likely to be in the same populations that also face barriers to access to financial product and services too. So it's the same population that is being left behind in both the digital arena and in the traditional banking system as well. And so, we've got to solve those issues in a really fundamental way and look at some of the underlying causes here if we actually want to make progress on financial inclusion when it comes to digital products and services. And instead, what's happening now is it seems like some of these crypto products and services might just exacerbate the digital divide and the unbanked problem. And so, I think those are very difficult problems to solve that involve psychological issues in some of these populations, potentially about some of the legacies of being excluded. It's delivering things like broadband services. Those are harder things to solve than just a blockchain exists or not. And so that's one of the areas that policy has a lot of work to do, in my mind, is really looking at what are the underlying factors here and sort of how you reverse those things, not whether, so how much is technology driven versus some underlying policy problem.
So speaking of technological difficulties, Rachel dropped out due to a computer challenge, and she is back. One of the things that underlies, the kind of common threads that ties the book together, because really the book is almost a case study approach. Not every chapter is a case study. Certainly yours wasn't, but a lot of the chapters are case studies. The first chapter and the last chapter definitely weren't. But one of the themes that runs through it that I've introduced, as a term, is what I call Generation T, which is the group of folks that were born in 2002 and later. I've talked about it, in earlier episodes and, in publications. The internet broadband to the home. I want to say the internet broadband wasn't deployed to the home until the year 2000. And by 2010, it reached 70% penetration and then kind of capped off, which is that digital divide that we've talked about before. The iPhone came out in 2007, and so people who were born 2002 and later, they were born into a digital bubble. they were born into a world very different from the one that you and I were born into, where, we had to learn to navigate the world without the help of the internet, without the help of devices, et cetera. If I wanted directions, I had to pull out the Thomas guide, or a map. For those of you who don't know what a Thomas guide is, a very complex map, but a map. And now we just everywhere, we've got it all on our phone. Rachel, you are squarely in the cutting edge of Generation T. We already talked to you. You don't have a checkbook. Do you use crypto? Do you have crypto? Do you use any form of cryptocurrency?
I personally don't use cryptocurrency, but I do know that's something that's often talked about. And I wouldn't say like more recently, but definitely a couple of years ago, that was a big thing among people my age, was talking about crypto and crypto mining and stuff like that.
But crypto mining as an idea to get rich, not as hey, this seems to be a smart banking system.
Yeah, exactly. More so as an idea to get, rich.
Yeah, and as I was listening to Graham talk about it, that's really what it seems like it is right now. It was originally pitched as an alternative money system, and maybe it was a reaction to the financial crisis. But it seems to me that it was, technological entrepreneurs, many of whom might have been rich, and those people who like to speculate, creating another asset class, not an alternative banking or alternative monetary system. And that's actually not necessarily a position I really had thought of, until I came into this conversation. But that's as I'm listening to you talk, that's kind of where I see it going. A couple other questions that I'm curious about. Obviously you were a regulator, and this one maybe not directly related to cryptocurrency specifically, but certainly I've seen the impacts there. The SEC, Securities and Exchange Commission, which regulates, the stock market, other securities, again, simplifying like you did earlier, which was fine. But then, Elon Musk changes his Twitter profile or X profile picture to the Dogecoin logo, and Dogecoin spikes. And right now, so far, the most part, and maybe it's just because, I used to consult electric vehicles, the ability to move the market by tweet seems to be relatively confined to Elon Musk. But maybe not. Maybe I'm just missing something. Market manipulation, changing the value of the dollar based on certain factors is really challenging to do, requires a giant conspiracy theory. The ability to change the value of cryptocurrency and individual stocks based on that is a lot, as we've seen, easier. How do you see, and I know this isn't necessarily something you touched on in your chapter, but the idea here is to take the principles of the chapter and look at other places. How do you see the interplay between social media, cryptocurrency specifically, stocks generally? You're not going to move a mutual fund necessarily, but you can move an individual stock, and the regulatory system. What do you think the role of the regulators? Can they stop that from happening, other than saying, hey, Elon, you can't tweet, and every time you do, we're going to fine you?
Sure. A great example of the dynamic that you talked about is something called a rug pull. You familiar with that term?
A rug pull, like pulling the rug out from underneath someone?
Pulling the rug out from underneath someone. It's a move in crypto. Again, I'm going to try to describe it at a very basic level. But the way that it works is you've got one of these crypto chat rooms. Everyone gets together and someone says, hey, we're going to go and hype up this specific coin over here. And we're going to try to get everyone to come in and buy it and drive the price up. And then when I give the signal, we're all going to cash out, and we're going to leave whoever the other unsuspecting, unsophisticated investors are holding the bag here with those losses. Now, the traditional name for that in the securities markets is a pump and dump scheme. It is clearly illegal if you are dealing with stocks. But crypto right now, at least for the time being, sits in an interesting area of regulatory uncertainty where we are not sure how the securities laws apply to them. The SEC has tried to bring enforcement actions against various crypto players in the ecosystem, but there are those actions are being challenged right now. And so some of the agencies are trying to bring their traditional tools to protect against things like fraud to bear, but they're just experiencing some issues with it because the industry is really fighting back. And it's saying, no, because there's a blockchain involved here, or because it has these certain digital features, it is not actually within your jurisdiction, SEC. Maybe it's in a different agency's jurisdiction. Maybe it's just a new novel product and service altogether, and the existing laws don't apply, and Congress has to step in here and tell us the laws do apply to us. And so there's a way in which, again, some of these schemes look the same as some of these traditional things that happen in the longstanding stock market and banking systems. Maybe some of these things are actually novel, and a lot of this stuff is being contested in the legal arenas right now.
Yeah, I would imagine. It's interesting, and I think I know what you're going to say. I came into this, and we talked a little bit before we started recording here. I feel like nuance is gone in the public sphere. It's just you're either for something, you're against something, and for the most part, you're virally for it or virally against it. And I am, or was, you're starting to become slightly, I don't want to say anti, but I came into this neither anti-crypto nor pro-crypto. I didn't think that it was going to solve all the problems of the world for some of the things we've talked about, here. Nor did I think, that it was terrible and we should get rid of it either. And I don't have your level of understanding, not even close, but I think I had enough of an understanding to form an opinion. I try not to form opinions about things I don't understand. But given how many multiple forms of crypto there are, we've touched on just a fraction of them. And while we were talking, theoretically, somebody could have created a new one. It's not like it takes that long or, really challenging. I don't see how crypto works with the dollar, the euro, the yen, et cetera, in any way other than an alternative asset class. But unlike the other asset classes, this isn't backed by anything. There's no housing market that's underlying this. There's no stocks that form a mutual fund portfolio that are backed by actual real companies. How can cryptocurrency work with the dollar, the euro, the yen in the way its proponents have argued that it should, as an alternative currency, not just as an unbacked asset?
I mean, I think the way to reconcile the potential conflicts here, the key to it really lies in that term that I used earlier of responsible innovation. So the question is, what is the value being offered by some of these products and services? What are the rules that apply to them? And then, how does the technology fit into that at the same time? And so to me, there's nothing inherent about a blockchain that says there have to be scams and frauds that necessarily go along with it, so long as it's well regulated. You don't have to have a rug pull that sort of accompanies that. So to me, part of it is the good actors in the ecosystem understanding, we want to be legitimate. We want to comply with our legal obligations, and we don't want to be tarred with this broad brush that this is just a haven for frauds and scams. So thinking about how these legal obligations apply, trying to comply with them, while sort of understanding why some of those rules are already in place. Because, there was that old sort of saying in the tech space of move fast and break things. There are some legacy rules that sort of might not be as modern as they ought to be in the investment space or in the payment space, but they're there for a reason. So the example that I think of is like, for us to send money from my bank to your bank, it usually takes 2 to 3 days for that transaction to be verified. That might feel like a lifetime if I want access to my money now. I've got bills that I need to pay. But that delay is there to verify that I am who I say I am, you are who you say you are, the money is actually there, it can be transferred. And then if something's wrong there, the transaction itself can be reversed. So instantaneous settlement gives me quicker access to my money. But once I send my money to you and it's in your digital wallet, it's recorded on that blockchain, it's gone and that can never be undone. So So sort of understanding how to reconcile those goals, those legacy goals exist for a reason. Maybe they can be modernized in some way, but there's a logic there that makes sense. So sort of how you reconcile some of the aims of this responsible innovation with some of the legacy systems that already exist.
I want to come back to something you said a few minutes ago and ask Rachel her opinion on it. But before that, I want to follow up on the last answer you gave. You didn't touch on the fact that unlike, most of the other assets, going back to the gold standard, crypto is not backed by anything. There's no underlying inherent value. If I am investing in a stock, yes, there's absolutely risk involved, but I'm investing in it because I believe that company is going to increase in value. There's something there. Bonds are the same thing. How does the fact that there is no underlying value, how does that? That's what I'm saying. It's not an asset class because it's a thing with no underlying value that's been pitched as an alternative monetary system. But as you've described it, it's not an alternative monetary system. It's an investment class.
Mm-hmm. Sure. I'm going to try to do securities law 101 here, or my best impression of it. But that is why, post 1929 stock market crash, some of these rules, the Securities Exchange Act, the Securities Act of 1933, those laws were created to create a disclosure regime for those kinds of investments. To say, when you're buying this thing, when you're buying stock in General Motors, what you're essentially investing in is the earnings potential of this company. And that issuer of that security is supposed to say to its investors, here's our outlook, here's our business strategy, here's what our revenue was last year, here's what we think it's going to look like in the years ahead, here are the factors that might impact that. And so the investor is supposed to understand when they buy that kind of thing, what is it that they are making an investment in? What are the prospects here? They're not supposed to lie. Those issuers are not supposed to lie. They're supposed to be as honest as they possibly can within some sort of realm of reasonableness. And so, that the argument the SEC has made is that kind of disclosure regime ought to apply to a lot of these other crypto coins, tokens, and what have you, is that the issuers of them, whoever that might be, has to say, when you're buying this, sort of what are you investing in or what are you speculating on? Is this supposed to be a bet on, whether the dollar is going to go up or down, whether inflation is going to go up or down, or some other sort of economic event altogether? And, so that's sort of the disconnect here, is you do not have that set of disclosures that apply to a lot of these various sort of crypto assets. And so people might think they're betting on one thing when they're betting on another.
Well, and you said, the issuer. I mean,
who is that?
There's an IPO, I know who the issuer is, whatever the company issued it. If somebody from America makes an announcement, but if there's some sort of, a warehouse in the Philippines issues something, as one of my old favorite New Yorker cartoons, it was a picture of two dogs, a black dog and a sitting there, the black lab sitting there using the internet. And there's another dog right next to it, and it, and the little paw, and he's turning to his friend and says, "On the internet, nobody knows you're a dog.
Yep.
On the internet, nobody knows where the coin is created. How can you apply traditional regulations to something that could be created in a garage in the Philippines just as easily as it could be created in a garage in Palo Alto?"
Yeah, I mean, under the traditional way those laws work is the platform or the exchange that lists it is supposed to do that verification work. It's supposed to know who the customers are and who it's supposed to certify the entities that it can actually list, whether it's a stock or it's a cryptocurrency or something else. And so that's one of the things that's being debated here too, is what are the obligations that apply to some of these central intermediaries within this whole ecosystem? Again, it's in some ways anathema to one of the purported goals here, which is full decentralization, full democratization. Well, if you have that full system, then it means that there are going to be anonymous entities using it that could be criminals, that could be hostile nation state actors, that could be people trying to defraud their customers. So that's, again, one of the areas where you run into some of these tensions where legacy laws have had to deal with that of we want to give people access to investments. We want to let companies go out and raise capital in these capital markets, but how do we reconcile some of those goals of us trying to verify these entities are real, they're not lying to people? It has constantly been a push and pull in these financial laws over time is how to strike that right balance. So there can be innovation, there can be access without promoting or encouraging or facilitating that bad behavior.
So as we're coming towards the end here, we're coming up on kind of about an hour, and we generally try to keep these things within a few minutes of an hour either way. A couple of questions. I want to turn to Rachel again. Graham, you said earlier that the traditional banking system is slow. Rachel, you've said you don't have a checkbook, and I understand that. I assume, and as a funny anecdote, I was talking to a very good friend of mine. We've been friends for 30 years now. His daughter is 15. She had a job this last summer, and she worked at the city pool as a lifeguard at the city pool. It was very close to her house. She could walk there. Because of the employee classification that she had, they paid her by check. And so she got her first paycheck and she looked at her dad and she's like, "Can you help me turn this into real money?" And she had no idea how exactly what it was. She'd never seen a check. She didn't know what to do with it. And so, yeah, of course, he did. Rachel, do you find the banking system as you engage with it slow? You have a different perspective than we do. Do you find it slow?
I think there are times where I'll get frustrated and I'll think, when I want to transfer my money from one bank account at one bank to another, I think why is it taking 2 days to transfer from my account to my account? In those instances, I do think it's slow. But with your example with checks, my first job, I also got paid with checks. And I thought it was amazing that I could scan. I didn't have to go into the bank because I didn't have a car. I could go on my phone, scan the check, and sign the back, and it would automatically deposit. So I think it's slow, but then sometimes I do put it in perspective and realize how interesting it is that someone can sign a piece of paper and I can scan it on my phone, and in 2 seconds, well, not 2 seconds, but in a short period of time, it'll end up in my bank.
Yeah, I mean, I think it's a lot faster than it used to be. And I think as I was listening to, one of the articulated differences, one of the main, it seems like, articulated differences you said, Graham, was really the speed of the transaction more than anything else is the purported advantage. And it sounds to me, and correct me if I'm wrong, before I come back to Rachel for a second question here, a lot of the slowness is either to provide surety and guarantees or something that could be changed and may be changed over time.
Yeah, I think that's right. And some of that can be changed. I mean, there are, not to go too far down a rabbit hole here, but there is a private interbank payment network and there's a public Federal Reserve administered payment network. These two sort of compete against each other. They have rails that ride alongside. Both of them are experimenting with real-time payment to sort of bring those transaction times down. And so some of the ways of solving some of these problems don't even necessarily need to involve crypto altogether. If the Federal Reserve, what's called the Clearinghouse Association, can really get people to adopt those real-time payments and services the Fed's once called FedNow, you could actually solve some of those problems without actually involving crypto altogether. And so there's a lot of experimentation happening in the payment space outside of the crypto ecosystem as well.
So Rachel, as our resident member of Generation T, I like to consider myself an honorary member, but as our resident, member of Generation T, has this I guess, did you have an opinion of cryptocurrencies coming into this conversation? And if so, what was it? Has this conversation changed your mind? And how do you now view cryptocurrency from a personal standpoint, not necessarily from a policy standpoint, because I know, like me, that's not your area of policy expertise. And again, I try not to weigh in on things that I don't have a foundation for. But just from a personal standpoint, where are you on cryptocurrency?
Yeah, I think, before, reading this chapter and having this discussion, my knowledge of cryptocurrency was definitely very limited. And I think something like that we touched upon in the episode that was really insightful to me was the fact that we talked about how cryptocurrency doesn't really work to help increase like inclusion in the financial world. And one of my key memories of doing research on cryptocurrency was back in 2021 when El Salvador established it as a legal, I think it was Bitcoin, as a legal tender. And I remember something around it, saying like, oh, this is their way of increasing inclusion. So I think it's interesting now after this conversation and reading the chapter, how it's not quite how it seems. I think definitely, like you were saying, Lloyd, there's a lot of nuance to it. So it's something that I'm definitely hesitant about. But this has definitely been insightful. And I actually wanted to quickly ask, we were talking about this a little bit earlier, but we've been talking a lot about the role of the U.S. and U.S. regulatory agencies and policies as they pertain to crypto. But given the borderless nature of cryptocurrencies, and I'm sorry to make you answer this question twice, but what role do you think international cooperation could play in regulating digital currencies?
Wait, do we have international cooperation these days? I sometimes wonder about that.
I think that the answer there is it sort of depends. Because crypto involves several different dynamics here, sort of banking, money, payments, financial stability, but also some national security and illicit finance issues. There are different aspects of it that have different implications for these sort of international coordination functions. So like on the regulation and financial stability front, there's been a lot of interest and discussion in these multilateral bodies that were created either years and years ago to coordinate around financial regulation or post-2008 financial crisis, where there's been some joint projects to think about what the financial stability implications of broad-based crypto adoption might look like, because there's been a realization on the part of countries that these risks that are truly threatening financial stability don't respect these sovereign borders, and so they spill over and they can spread across the globe. And so there's been a lot of collaboration and coordination on thinking through some of those issues from a regulatory perspective. The flip side of that internationally is that there are also countries that want to be the first movers in the crypto space because they see an opportunity to bring in money and jobs. And one of the ways to do that, it's often argued, is to actually not really regulate or to deregulate. And so there's a tension here between a lot of these countries in these multilateral bodies of we want to protect against financial stability, but some of them want to be competitive and attract business. So that's been a really sort of delicate way to balance some of those regulatory issues. The issue of sort of money, payments, and financial inclusion, sending money cross-border, particularly to lower income countries, is often a challenge. And so there's a lot of interest in thinking about how either private or public options here, either publicly government-created payment systems or some of this private competition could actually help to facilitate that. And it's a similar sort of thing where you could get benefits out of it depending upon which way you go. If it's a state-created one, it might be lower cost. But at the same time, there are increased risks of surveillance from countries looking at the transactions that are coming in and out of their borders. The flip side of that is you bring too many private actors into the space and don't monitor those transactions well, you make it easier to do illicit finance, money laundering, and things like that. And so it's the shortest answer, and what has been a very long answer here, is it's complicated because each one of these dynamics cuts in a different way towards public and private, towards centralized or decentralized, towards coordination or competition. And so it's been a really complex international dynamic to try to manage across those two areas, both regulation, but also financial inclusion.
So before I ask the last question, it's interesting. I think, one of the things that I didn't necessarily, I thought it'd be kind of a bit of an aside, but one of the things you brought up early on, and it's woven its way through this conversation, is, banking inclusion or exclusion, not just digital exclusion, but banking exclusion. And while crypto doesn't hold promise, I think there are a number of fintech companies, as you look around the world, that offer alternate options to the unbanked, M-Pesa throughout North Africa and the Middle East is one of those. And there's a number of ones that offer some innovative, but ways that have a greater ability to be part of the system, not outside the system, but still accomplish the goals of better inclusion. That would be a whole separate conversation that we could have some other time. So last question. So I think we've answered the first part of this. When I asked you to write a chapter for this book, as I was conceiving the chapters that I wanted to make up the book, I thought we could not possibly have a book on technology and government, without talking about cryptocurrency. And the book itself is called Technology versus Government, because, the irresistible force meets the immovable object, because of the exact tension that everybody recognizes, between government and technology. And I viewed cryptocurrency in that same realm. The idea that here's another technology that, has the ability to, at the time I was thinking about this, obviate the need for the central banking functions of government. I no longer, after this conversation, feel that is imminent. I don't think that we're in a place where it's going to, we're going to go around the central banking functions. I do see that, the way you have described it now and the way I had understand it prior, there's potential for chaos, there's potential for bad actors, there's potential for a whole host of problems. But I as I'm seeing it now, cryptocurrency strikes me more as a niche product than a complete elimination of the central bank and central banking and monetary policy. So I'm going to ask you for the last question to prognosticate. That's today. We know, Moore's law, the technology acceleration, et cetera, et cetera. What do you see for the future of cryptocurrency? Do we have the same thing we had in other areas where they all jumble around and eventually one settles out and, Google becomes the dominant search engine and there's a dominant crypto and that's it? Do you see it? Eventually they get it right and it eliminates the central banking functions. Do you see it remaining a niche investment tool? Do you see it just going away completely? If we had this conversation again in 10 years and 25 years, where do you see, and not just the currency itself, where do you see the currency itself and the relationship between government? In 50 years, do we have a central banking institution?
Oh boy. Well, if there's one thing that I learned from my time on Capitol Hill, it's that prognostication rarely ever works out well for the prognosticator. And I was bad at it when I worked in DC, and I'm even worse since I've moved back to academia and gotten sort of disconnected from the policy world. Maybe I'll try to offer a few thoughts though. I think there was a thought, let's say a decade ago. So the first Bitcoin white paper was in 2008. And there was a thought a few years after that, we'll say around 2013, 2014, that the whole crypto sector was illegitimate. It was all just a bunch of fraud and financial bubbles, and it eventually would sort of burn itself out. And there's been significant investment in this space, in a large amount of private investment in particular going into the entities and the technologies underlying them. And so I don't think it's going away. I think there will be more investment. I think there'll be more experimentation. There's a lot of money going right now into the political process, frankly, in order to try to drive policy outcomes that will further legitimate and entrench crypto into the broader financial ecosystem. So whether they have gains on the private sector innovation front, whether it's in the public policy front, I think it'll be around for a long time. Now, the question then is sort of, what does that look like? To me, I think or hope a lot of those frauds and scams go away over time as some of the use cases play out, and we can sort of see what the value proposition is here. I think a lot of the experimentation that's happening, a lot of those issues are happening because it's just sort of not clear what the most effective use cases are going to be. So I guess that is my hope, is that really focus in on sort of what is the value proposition, and that's where the development actually happens, not in some of these other sort of the speculation, the fraud and scams and things like that. But all that is, I should acknowledge those sorts of activities have been with us. They were with us in the traditional stock markets. They're with us in these markets too.
I think some of those things are just never going to go away, no matter what the technology is that underlies it.
Okay. Well, I mean, but we'll see what happens. I have far less foundation than you to make any prognostications, and I'm not going to. But I will say, the nature of it being unbacked, causes me to be a little concerned as to what its durability is as a value versus a flash in the pan niche. Blockchain, I think, has huge implications and could be around as a secure ledger for a long time. Crypto, I'm not sure. I'm not sure that eventually the banking institutions and the government bring the current banking institutions up to par. And I don't know. I'm not sure where it goes. I don't think it eventually gets to become replacing the monetary policy. But I could actually see it going away.
One other factor I should say on the investment side, I know you have another chapter that's on AI. A lot of the investment that had gone into crypto is now shifting into AI instead. So, one question to me is how much that sort of cannibalizes what had been prior crypto investment, and that needs to a little bit of curtailment as well.
Graham, thank you so much. I have enjoyed I've enjoyed your chapter. I went back and read it again, and I've enjoyed the time we've spent. It's been fantastic. Rachel, again, thank you. It's always great to have your perspective and your contributions. You're incredibly informed and really offer a great counterbalance as you bring the Generation T perspective to all of these conversations. So thank you, and join us next time when we discuss AI and public policy as we look at the afterward, where I sat down and interviewed, quote unquote, ChatGPT from the framework or mindset of I'm sitting on the stage interviewing a technology leader. We're going to bring in some special guests. We might even have a guest appearance by ChatGPT, and we're going to discuss the implications of a wide variety, not just generative AI, but AI in general in the public sphere and public policy. So until next time, this is Policy Chats. I'm your temporary guest host, Lloyd Levine, and thank you very much for joining us.
Thank you for listening to Policy Chats, the official podcast of the UC Riverside School of Public Policy. If you enjoyed today's episode, be sure to follow us on Instagram at UCR_SPP. To learn more about our program and upcoming episodes, visit spp.ucr.edu. For the video version of this episode, check out our YouTube channel at UCR School of Public Policy. Until next time, stay informed and stay engaged.